Thank you. My name's John Fruitkin, and I'm from Phoenix, Arizona. And I am part of the conglomeration of lawyers that have been active in the crowdfunding space kind of since 2012. Um, we're lucky enough to have. I did a panel with Sam where I said we have three of the five best lawyers in this topic right here on this panel. And with the inclusion of the last panel, now we have all five. So this has worked out perfectly. I'm going to do the quick introductions just to save us time so we can talk about the actual topic. Right next to me is Sam Guzik. Sam is a really well-known securities attorney from Los Angeles, and a major influence around what we're going to be talking about today, is specifically Reg A+. He's going to really give us kind of a little bit of a flavor of what's going on and what has transpired and where we are. Next to him is Mark Roderick. He's with Flaster Greenberg in New Jersey. He's a prolific writer, as is Sam, and blogs at crowdfundattorney.com. He also went to UVA Law School, which my understanding is the best damn law school there is.
In Virginia.
In
In Charlottesville.
quite frankly, on this stage, for sure. Sam, I don't know where the hell you went.
East of Palo Alto.
So in any case, we've got Steven Sadler. In a space in which I have personally seen a lot of interest and growth in this area, in the commercial real estate asset management space, Steven's been very, very quick to embrace various different types of alternative finance. Did a Reg A offering last year, is looking to do a Reg A Plus, I think, this year, which is great because it's really going to explain to us, I think, what market leaders are thinking about. And so we're lucky to have him. And then we have Craig Denlinger from Denver. He's a Deloitte guy, you know, but they set him free. So now he's free from Deloitte, and he's really known for us as one of the kind of go-to auditors as we move into this new uncharted territory. So we're going to look forward to his comments. But Sam, we got to start with you. If you could talk through a little bit about how we went from a world in which Title IV was for, quote, qualified investors, and all of a sudden that means everybody gets to do them, and what all this means. It's been an amazing year for Reg A+.
Okay. Essentially, Reg A Plus it's a lot of different things, but let me just try to break it down to something very simple. First of all, it is essentially a registration process. You do need to file a registration statement with the SEC. You will be reviewed. You will get comments. The benefit of it is when you come out at the end of the process, you can sell free trading securities. So you have liquidity, and for those folks who say 506 is great, we don't need Reg A Plus, that may be true for a lot of folks, but at the end of the day, there are companies that need to be able to raise capital through selling liquid securities as opposed to securities where there's no exit. Secondly, Regulation A Plus allows a company to sell securities to both accredited and unaccredited investors. Now, there are limitations on how much unaccredited investors can raise, but I think that's for many companies, that's a very important factor. Important because some companies simply can't get the money they need from accredited investors. Some companies would like to have a broader base of investors for any variety of reasons. Some types of businesses appeal to certain affinity groups, which are unaccredited. And so that's a real benefit. What Reg A Plus did, and the reason it's revolutionary, and the reason nobody ever heard about Reg A as opposed to Reg A Plus, is when you go through Reg A Plus, you only go through a federal review, and before that, you had to go through both a federal review and a state review in every state where you offered and sold. And the problem with that is not only does it add cost and time delays, it adds uncertainty, but in states where they have merit review, if a state securities commissioner or a staff person doesn't like you, you're not getting through. And the most famous example of that was the state of Massachusetts in connection with the Apple IPO, where they basically barred the sale of Apple stock to retail investors back in 1980, along with 17 other states, which don't ever get named. So that's really the big thing now. You can go out to a broad group of investors. The other thing is cost. It's intended to be, and I think will be in operation, more cost effective to both go public and remain public, and we can talk about the specifics of that, but I think that's it in pretty broad strokes. It goes effective on June 19th.
Mark, let's just talk a little bit so we have a baseline for the rest of what we're talking about the difference between what the SEC, and probably the SEC only, refers to as Tier 1 and Tier 2. And then talk about, from your perspective, whether or not there's any kind of potential market for Tier 1. If you could talk about those two issues.
So, first I should say that I wrote a whole primer on Regulation A at my website. So it's all this stuff sounds, Regulation A can sound complicated. But I guess if you spend hours and hours with it, it's not. So Tier 1 and Tier 2. Tier 1 is the old Regulation A, just with a higher limit, 20 million rather than 5 million, really. But since a lot of people don't know what old Regulation A that really doesn't say very much to the audience assembled. So the differences between Tier 1 and Tier 2 of Regulation A. Tier 2, I'll start with because it's probably going to be used a lot more. Tier 2 is the part of Regulation A where you don't need states to approve the offering. Okay, what Sam talked about, probably the key feature of the new Regulation A is the so-called state preemption, where you only file with the SEC. You do not file with states. However, that is only Tier 2. It is not Tier 1. Tier 1, you still have to file with states. So that's probably the most significant difference. The other difference is you can raise more money under Tier 2, $50 million per 12 months versus $20 million per 12 months. So far, everything about Tier 2 is better, right? You get the state preemption, you get to raise more money. The limitations on Tier 2 are two things. One, you need audited financial statements under Tier 2. You do not need audited financial statements under Tier 1. Now, because Craig exists, that's not going to be all that much of an issue. But Tier 2, you need audited statements. And the other thing about Tier 2 is for non-accredited investors, and don't forget, non-accrediteds can invest under Tier 1 or Tier 2. But in a Tier 2 offering, non-accrediteds are limited to how much they can invest. It is limited to, I thought I said something wrong, and Sam was beeping me. Non-accrediteds in Tier 2 are limited to the greater of 10% of income or 10% of net worth. That is only Tier 2. In Tier 1, non-accrediteds can invest an unlimited amount. Now, the 10% limit, when you think about it, is not a very significant limit. For one thing, that is a 10% limit per deal. So a non-accredited investor can invest in 10 deals and invest 100% of her income or net worth, whichever is higher. 10% of somebody's income or net worth is a big number, right? Think of, and well, Sam, I mean, that number 10% runs in the hundreds of millions of dollars. But even for a typical investor, 10%'s a pretty high number. But nevertheless, that is a difference between Tier 1 and Tier 2. There's a limit on how much non-accrediteds can invest. You have to file audited financial statements. And finally, one other limitation on Tier 2, one other sort of bad thing, is that if you have more than 300 shareholders, you have to do annual reporting. I'm sorry. I think semi-annual reporting. You have to do ongoing reporting to the SEC. So under Tier 1, you file, no audited statements, you're done. Under Tier 2, if you have a lot of shareholders, you file with audited statements and you keep filing. So there is a ongoing cost, a compliance cost, sort of trickling into the territory of a fully reporting SEC company for Tier 2 offerings. So those are the primary differences, and that's why most people are interested in Tier 2, because the state preemption. So if I want to sell securities and I'm almost any kind of company, I don't want to be limited. I don't want to have to file in multiple states. I want to raise money from everyone in the universe, so I'm going to use Tier 2. But to answer your question, Tier 1 is still viable in some situations, and I have clients who will use Tier 1. So, for example, if you are doing a community development project in Minneapolis, for example, you really are looking at investors from the community, from Minnesota, you know, even from that particular little community. In that situation, you may use Tier 1 because you don't have to have audited statements and you don't have these other minor limitations. So in that situation, I think, and probably in that situation only, Tier 1 could be a viable alternative because it is somewhat less expensive and burdensome.
Obviously, kind of statistically, Tier 1 offerings, which we used to just call Reg A, they were very limited in number. There were dozens of them a year, certainly not hundreds and thousands. And there are not a lot of people, probably not a lot of people in general that we could find that have gone through that, but one is right here. So let's move that down to you, Steve. Let's talk a little bit about why you made that decision, how it went, and then why now you're looking at doing Reg A+.
My company, my name is Steve Sadler. I'm the CEO of Allegiancy, and we are a real estate services company. So we're an operating company, not a real estate investor or owner. And so that's a distinction, I think. Regulation D has been used extensively for real estate investments. In our case, we're funding an operating company, and we expect to have ongoing capital needs. So we did a Regulation A offering last year with the express purpose of sort of, I guess, making a path that we would be able to understand, do some of the learning early. Here. Is it working now? Hello? There you go.
There you go.
Thanks. I'll just steal one. So we undertook a Regulation A offering really as a way to blaze the trail in anticipation of Regulation A+. I think most people here would understand that the costs of doing an offering really don't change a lot based on the size of it. So a $5 million offering under Regulation A is almost as expensive as a $50 million offering might be. So the economics get a little squirrely when you're doing a small deal. We undertook and decided to pay that price in order to learn the ways of the world and be ready when Regulation A+ came along. And so we're expecting at Allegiancy to file for $30 to $50 million A+ offering on or about June 19th. Put that in front of our close friends at the SEC so we can start the dance. Regulation A, last time it took us about 120 days, 5 rounds of comments to get through their process, and that's not inexpensive. But ultimately,
How many states did you go through?
we applied or we sent documents out to like 10 states. We're based in Richmond, Virginia. We ended up pulling the request from a number of states as they started to become problematic. But ultimately, if you don't know this, the state issue is a big one because every state has their own little pet bugaboos. And if I go to Ohio and they say, hey, you need to change paragraph 3 and these 5 different elements of your offering, I now have a new offering. And now everybody gets to see the new offering. And so you end up in this circular back and forth that ends up costing you tons of time and tons of money. And the people that are, in our case, we were using an independent broker-dealer as an investment banker to lead the offering and place the securities. And Maloney Securities was in a position where they had the offering largely subscribed, but we had to keep waiting and waiting for the various states to get their act into gear and get this thing approved. So we're really excited about the preemption. We found that to be enormously painful. We were held hostage, literally, by the state of Virginia's State Corporation Commission on things completely unrelated to Allegiancy. That they said, well,
As long as we got you.
while we're talking, yeah, if you'd like to have your Allegiancy offering, approved, we need you to address these 50 other unrelated things that we have no statutory authority over. But if you do those, then maybe we can get this taken care of for you. Otherwise, wow, busy, time to go.
So
Yeah.
I think the fact that Tier 1 exists at all is really kind of a bit of an action by the SEC to kind of placate the state regulators to allow it to even exist. I think for everything you described, there's much more appeal to using what I'll just refer to as Reg A Plus or Tier 2. And because we're about to talk to an auditor, that way we can get ourselves back on track, because audits are required in Reg A Plus offerings.
Well,
Why don't you-
and a lot
yeah.
of 506 offerings, a lot of the Reg D stuff, people are doing audited financials, and so there's a perception amongst the investor base that audited financials are really good and an important thing. Now, we could argue whether that's true or not. I'm pretty sure I know what we would say, but there's a lot of that, regardless of Reg A.
Let's then focus on an issue, which would be the either very limited operations or the really raw startup, for whatever various reasons does in fact decide to go with the Reg A Plus offering. We still doing audits, Craig?
Yeah, it appears so. I actually just put in a question with the SEC to clarify that, because I wasn't entirely sure it was explicitly clear in the final rules if it had started less than a year ago. So I guess we'll wait and see on that answer. But I think at this point the plan is to perform audits for any company doing Reg A Plus audits. And
The answer is yes.
It is.
Yeah, the answer is yes. I'm not the SEC, but that's going to be the answer.
I will vote with Sam. But yeah, audits are required. And the good news for auditors and ultimately the market, quite frankly, is that this will give a lot more credibility, hopefully, as we move forward, that these numbers have been looked at. And
Well, and the other part of that is that with Regulation A, either the Tier 1 or Tier 2, part of what you're looking at is a freely tradable security. And for the security to actually trade, people are going to want information. And so the reporting requirements in Tier 2 are helpful in that regard. But if you have a Tier 1 offering and you have, in our case, Maloney Securities handles secondary market trading in our offering, and we'll expect to do that on the next one. But if you're going to actually have somebody come in and buy those shares in the secondary market, they're going to want some information. If you're completely unprepared to deliver that, and you don't have audited or even maybe GAAP financials, you're going to have a heck of a time creating liquidity, and that's one of the big deals, right? Because I want, at Allegiancy, I want currency to hire the best people I can find and reward them as we're successful. So my shares become currency for that. I want currency to make acquisitions so that I can go out and grow my company through M&A activity as well as organic growth. And the liquidity is a critical part of that.
I do want to get to that, because that's an important area, and I'm going to turn to Sam for that. But
We have a question back here. You want to take?
yeah,
that, Sam?
sure, Steve, yeah.
Question on the audits, where the accountancy is providing an opinion. Is there an issue with these emerging companies doing the A+ offerings where the opinion will have a going concern clause? And if in fact that happens, how is that going to impact the offering?
most of them are going to have the going concern opinion. I would say anything going to Reg A Plus is going to fit in that bucket. However, that doesn't disqualify their offering or anything like that. It's actually very typical of small businesses to have that, and even long-standing companies that have had a couple years of losses, whether they're, actually in any risk of bankruptcy. We're accountants, we're very conservative. We slap that opinion on anything that looks risky.
Yeah, that's not going to be a problem. That's expected. I won't say most, but the majority of Reg A plus filers will have that in there. They will have a qualified audit report. They will have a risk factor, which cites this specifically in connection with, and that's fairly standard stuff.
Go ahead.
Could you talk about, I'm looking here at Mark's primer, actually.
God, I hope it's not a
I
mistake.
told you
Yeah, thank you.
twice, because I'm not very good. But if you have less than 300 investors, even with Tier 2, you do not have to file the SEC, is that correct?
Yeah, that is correct.
If you have more than 500 unaccredited, you're de facto.
No, you didn't read the next page. No, all Reg A investors are ignored so he's talking about the rule that says if you have more than 2,000 investors total or more than 500 non-accredited, you have to become a reporting company. But Reg A investors are ignored for purposes of that rule. So you can have 5 million Reg A investors and still not be a fully reporting company.
With the caveat that you need to use a transfer, or you need to have somebody.
You have to jump through some hoops.
Yeah, you need to have a third party keep track of your shareholders, et cetera. So there's a little bit of a hoop there, but as a kind of, we'll just call it a compromise, there's not a requirement that you become a full reporting company if you take advantage of Reg A Plus, which we'll get to in 1 second about the choice to become a reporting company.
Third-party companies, same companies, they take care of public stock transfer.
They're transfer agents, so they need to be registered transfer agent. But that's different than being than being a reporting company. It's different than being traded on an exchange, and so it gives some flexibility to these Reg A Plus.
Well, and all those things have costs, right? So
Yes.
your transfer agent's going to cost you $300 a month, and you have to evaluate those costs with respect to the overall picture. But I think again, from our perspective as an issuer, the liquidity component is absolutely the number one reason that we're looking to do a Regulation A plus offering. We want our investors to be able to come and go as their needs dictate, and all of these things. The transfer agent's a big part of that. DTC is a big part of that. I mean, there's a lot of
I'll get back to
moving.
me. So this keeps coming up. So you go through Reg A Plus. It doesn't necessarily mean that you're a reporting company. It doesn't mean that you're traded on an exchange. What has the SEC done to make that, we'll say, easier, or not easier in your view, with Reg A Plus rules?
As far as
taking to market something that was done with the
And
Reg A
maybe
Plus.
what more could they do?
Yeah.
I'm
I'll defer to Mark, and
Mark,
then you'll be
if
able to fill in.
Take it away, Mark.
Well, there's not a whole lot to say about that. The securities, one of the things none of us have said, but it's been implied by what all of us have said, is that securities purchased in a Regulation A offering are freely tradable. So there's no Rule 144 restrictions. Now, you may have issuers putting restrictions on tradability or first rights of refusal or things like that, but they are absolutely freely tradable. Your investor can go out and sell them, and that's just how it is. There's no restrictions. However, saying there was no restrictions is a lot different than saying that there's an active public market for those shares. And there are a lot of people, and maybe someone in this room is going to raise their hand. There's usually someone in a room like this that's working on a secondary trading platform. But the SEC could issue rules to make it easier to set up those secondary trading platforms. And I see Sam now wants to chime in.
So
So-
I got
Now
Sam
you
caught
got-
up.
now
I'm
it's
sorry.
I understand. I think I understand where you're going from.
Yeah.
Unless you say Mark is off on a tangent.
No, that's where I was going.
One of the things I've talked about is why should people be paying attention to Reg A Plus? Because some people, like anything new, whether it's 506C, they're dismissive of it. And one reason people ought to be paying attention to it is, yes, there's a concern where these shares are going to trade, and not so much where they're going to trade. They can trade on OTC markets. How are they going to trade? And there's a problem whether you're on OTC markets or you're a micro cap or nano cap stock on NASDAQ. And the answer to that that's getting a lot of attention in my world, and you're going to start to read about it, is something called venture exchanges. And for those of folks in this room, I have here in my hand, it's actually a bill that's going to be introduced next Wednesday in the House Capital Markets Subcommittee. And it's a bill which will essentially authorize and legitimatize venture exchanges. And essentially, that's really the companion to Reg A Plus, because it's great, you go, you sell your stocks, but if there's no aftermarket, they don't have the right environment to trade in, then ultimately you've only solved half the problem. There are a number of people out there who understand this, both people in the industry, also SEC Commissioner Gallagher. So we're going to see, I expect sometime this year, legislation passed which is going to legitimatize venture exchanges, which are going to be markets that are specifically geared towards Reg A Plus securities, will allow companies up to, as presently formulated, $2 billion in assets, up to, and there's a reason for that.
Market cap or
allow different types of trading rules than you're currently allowed under SEC regulations. Things like tick size, things like how securities trade. For example, thinly traded securities, there's oftentimes a buyer but no seller, and vice versa. And so you need to have different ways of trading. For example, trading at set times by auctions, so you allow orders to accumulate on both sides. You can't do that now under current SEC rules. So this is going to be I think it's going to be something that's going to really be a shot in the arm, adrenaline for this market. It's going to take a little bit of time, but everything new, as Doug Eleanor pointed out, takes time.
Well, and it's part of the ecosystem, right? So we talked about crowdfunding in the last panel as sort of the beginning of that ecosystem. Reg A, perhaps Tier 1, and then Tier 2, and then secondary market trading platform like the venture exchange. But ultimately, I think you're going to eventually see a lot of the people who are currently resistant. So, and I was speaking on a panel in Atlanta last week, and in the two panels prior to mine, they were led by attorneys, and this is one of my favorite terms, the words jail time came up over and over again about people who are going to be participating in, crowdfunding platforms under 506C or Regulation A offerings, and there was a real, I think, overt effort to inject fear into this equation, and I think it's a false thing. Well, I mean, the regulatory environment can be challenging, but jail time is pretty rare. And our friends on Wall Street are doing quite well at avoiding jail time. But ultimately, there are a lot of established players, whether it's Pacific Exchange or whomever, that will probably come into this. And I think we're going to see a second wave. After the early adopters take a few arrows, all of the rest of the groups are going to come back in, and I think we will see a lot of liquidity and a lot more activity. But a lot of entrepreneurs that I talk to think being publicly listed is, or having public stock is this nirvana. But the reality that anybody in the business will share with you is you've got to work your tail off to create a secondary market and interest in your securities, because if it's freely tradable and it's freely traded and there's no bid because nobody knows you, the price is going to go the direction you don't want. And so back to Craig's efforts on the audit side and the informational, dissemination component. I mean, that's a big part of this too.
For sure, we get.
I have a two-pronged question for Sam, and that is it anticipated that all types of securities under Reg A Plus will be tradable on this exchange, LLC interest, stock, whatever it happens to be?
Yeah, I mean, the bill that's introduced and everything I've heard indicates that it's focused almost exclusively on Reg A Plus securities. And in fact, I just had a meeting yesterday with an SEC commissioner, and we were talking about the venture exchange. And he said, as if he didn't need to remind me, he says, because I'm going to be talking to some folks on the Hill next week, says, remember, when you talk about venture exchanges, talk about Reg A+. And in fact, in the bill, it explicitly applies to securities exempted under 3B of the 33 Act. Those are Reg A+ securities.
All Reg A securities.
Well,
I mean, we can stop saying Reg A plus now, right?
Oh, that's a good point.
well, that's up to you. I'll say Title IV and be safe.
Yeah,
So Title
Title
IV is, yeah.
But seriously, Tier 1 securities will be covered by that bill, right?
Well, in theory, yes, but if there's no ongoing reporting, they're not going to trade anywhere. I mean, a Tier 1 security has no ongoing reporting, and that's fine if you're a real estate company and your investors only expect reports once a year, and they're happy with that. And the other, yeah.
And I think, and maybe I'm wrong on this, but I think that if you don't have clearance, on your Tier 1 offering, it just states, right? You still have to file an S1, et cetera. So you're not going to be in a situation where you could have 10 states under coordinated review on your Tier 1, and then you're going to be able to trade on a venture exchange, I wouldn't imagine. But
No, you're not going to meet the requirements. I can assure you that there's not going to be any venture exchange out there that has no ongoing reporting or limited ongoing reporting. It's
Well,
not going to
the
exist.
intermediaries, right? The broker dealers, the registered reps, all of these guys are regulated by FINRA, and the last thing they want to do is raise a red flag in front of that bull by selling securities where there's been no information for the last 24 months.
So why not expand it to be a universal exchange for all private equity securities? Why
Well-
carve out A plus, A plus?
Well, it will include private companies. Because there's another class of securities which are private companies issuing securities under Rule 506, and at some point they are tradable, but they have no. Well, I won't say they have no place to trade, but it's very limited. So that's expected to be incorporated. In fact, when Chair White spoke to this issue a couple of months ago on why we need venture exchanges, she said, we've got lots of securities that are going to be coming out of Reg A+. They need a home. We have lots of securities coming out of 506 private placements for private companies. They need a home. So the target is both, but this particular SEC commissioner said Reg A+. Remember, Reg A+, and it always ties the two together.
we have a
So,
question in the back.
yeah.
Yeah, what's the chance that, so there was a hearing March 10th, Senate Banking, on the venture exchange and small cap companies.
Right.
It was attended by the Director of Division of Trading of the SEC and the President of New York Stock Exchange Group, as well as the EVP for Listing Services from NASDAQ. So what we were thinking was, well, this is clearly where they're going, right? This is clearly how you're going to put liquidity into crowdfunded Reg A and possibly Title III securities. What's your thinking there in terms of the path? Now that you say, so this was talking about a Senate bill,
Right.
on venture exchanges.
Right.
Now there's a companion piece of legislation on the House.
Right.
So
Right.
that's pretty much what you need. Those are
Well,
the
there's
points of
it takes a few constituencies to get legislation done, and this is major legislation. The good news, if you believe Chair White's public statements, which I do, and you believe what she's already had the Small Emerging Business Committee focus on, which Sarah Hanks is on, focus on. The SEC is strongly behind that. In fact, all 5 commissioners have spoken out in favor of venture exchanges. So that process started. There was a Senate Banking Committee hearing, and it was really to listen to input from trading and markets at the SEC, NYSE, NASDAQ, But that was basically, all that was doing was laying the foundation. So at the end of the hearing, they said, fine, what are the next steps? It has to move on the Senate side, it has to move on the House side, it has to it should have the support of the SEC. So all these things are moving together because the right people in power see the big picture, they see the need for a new type of venture exchange. So everything is moving forward, and the hope is that by the end of the year, we'll actually see legislation.
Part of this picture too, that I think is really important for all of us to keep in mind. You may have seen Gallup's articles posted where, for the first time in this country, business deaths are exceeding business startups. That's a big deal in a country that's based on an entrepreneurial capitalist sort of ethic. You're also in a position, as people in the securities industry, there's something like 6,500 publicly traded companies representing $15 to $18 trillion in value. There's 27 million private companies representing over 70 trillion in value. And so there's an enormous untapped market in this equation, and that's really part of what I think Chair White is talking about, and part of why there's some momentum in Congress to address these issues. You have an entrepreneurial class that is withering, in large part due to lack of access to capital. And finally, I think in 2012, the Congress took decisive action. It's all starting to work through, and that ecosystem is really coming to life. And I think it's a big deal for the country, for the economy, for the entrepreneur.
So I guess we know real estate would be an obvious sort of asset class where this could work really well. What other asset classes have you had preliminary discussions with, and this comes across the board, where you think that they might do a Reg A Plus offering as part of this first group this year?
Well, judging by the phone calls that I've gotten, and I've gotten a million phone calls, it is across the board. Now, I'll just make one point, because I didn't make it before in our summary. One thing you cannot use Regulation A for is to fund an investment company. Okay, you can't form a company that's going to own securities in other companies. I have gotten a lot of calls from entrepreneurs who had the great idea to use Reg A to form investment companies. So that's one thing that you cannot use it for. I think the issue is what is going to be most immediately saleable, right? Because as an entrepreneur, if you're in a business, you need to raise capital for that business, then that's one thing. But if you're looking to use Reg A as sort of an entrepreneurial vehicle, the question is what is going to sell well? So what has sold well in Title II, of course, is debt. So I have a number of people, very creative people, who are looking to sell debt instruments, just a financial instrument, just like a promissory note that is going to have a certain yield. It's just going to be a much higher yield than your typical investor can get these days. Outside of that, the other obviously major asset class that I've had a ton of calls for is real estate. All kinds of real estate, particularly real estate debt, but all kinds of real estate projects. Hey, you have a question?
I'd actually be interested to know what you think, or where in the real estate sector you think Reg A Plus could be the most viable. Because I think for a single project, to wait could be very difficult, right? But can you treat a Reg A Plus kind of like a series where you're taking things off the shelf?
You could, yeah. You can do shelf offerings in a Reg A offering. You can register the offering and then start taking it down at different times. But the calls no one's calling me and saying, listen, I want to raise $40 million for anything, for this real estate project. And I want to raise it all under Regulation A, because that's just not happening. There's no market. We in crowdfunding so far, we raised $2 million. Your patch of land. So you don't raise $50 million. But the calls that I'm getting are people who either see this as a whole new financial vehicle and they're going to be very entrepreneurial with, or are an established player. I have a company that does gigantic development projects in the Caribbean. So they're saying, you know, this is our future. This is just the internet. This is online capital raising. We're going to use this to raise a little bit of money, and we're going to figure out how it works the same way these folks are. And then as the market, as the ecosystem develops, we're going to use it to raise more and more money. So the answer is all across the board, debt first.
Yeah, I actually think, just from what I'm hearing, debt will be a part of it, but I think that the headlines, unlike, I think the headline's really going to be on the equity side. And I think really time will tell. We're going to have to kind of wait and see for which companies and industries Reg A Plus works best. So at this point, we only have speculation, but I think there's certainly some reasonable expectations that I have. Certainly for the biotech industry has been, as an industry, has been one of the most active proponents of Regulation A+. Very openly, I think that at least there's an expectation in that industry that it'll be useful for them, probably because until at least last year, biotech companies have basically been shut out of the IPO market. So I think they look at this as an alternative. I have a client now who may be actually the first test case for that, and they're saying we're happy to be the canary in the coal mine. So we'll see how that works out. I think there are going to be other various niches. I think companies which have strong affinity groups are going to find Reg A Plus very attractive. It can be, for example, a very popular consumer product which simply doesn't get traction with VCs. I think anything that doesn't get traction with VCs, folks are going to be looking at Reg A Plus as a possibility. Also, even mature companies that are not big enough for an exchange listing, we're going to see those types of companies looking at Reg A Plus. Reg A Plus is a very attractive stepping stone to an exchange listing for companies who are don't quite meet the standards or don't feel that they want to be subject to all of the governance requirements that go with a national exchange listing.
Well, Sam,
and just let me finish this one point. We've all heard about reverse mergers and various shapes and sizes. One of the things that Reg A Plus will do is, if clients come to me and they're saying we're thinking about a reverse merger, what's the difference between that and Reg A Plus? In 90% plus of the cases, they're going to go the Reg A Plus route, because with a shell, you have to pay money for the shell. It can be as much as $300,000. You're buying unknown problems. You don't have a real shareholder base, and you essentially immediately become a fully reporting company when you do a reverse merger, versus Reg A Plus, where you're not fully reporting. You report semi-annually. There's a very big cost difference. I'm sure I've already encountered this, what it costs for ongoing outside accountants for a Reg A Plus company versus an S1 from one of your smaller competitors, a major middle market firm, and the costs are literally half. Because, and I just give you an example, quarterly reviews, they say $25,000 a quarter. Semi-annual review, which is all you need to do with Reg A Plus, it's the same $25,000. So to a lot of companies, they're saying, hey, I can live with semi-annual reporting for now and save that $50,000 because that's money down the drain. Some companies will voluntarily report quarterly when they feel it's to their benefit to do so, and many will for a number of reasons. But
well, for us, for example, I mean, we do quarterly reports, but they're not audited. I mean, it's, you know, internal financials that we present to our investors. I think
but they'll need to be reviewed, and that's going to,
that's right.
Yeah, they're going to, that costs money.
But one of the things that we see, I mean, I'm sort of an evangelist for Regulation A Plus, and I'm out talking to people, and we have companies that are in insurance services, companies that are doing automotive-related businesses. I mean, You've got companies that one of them is a security firm, as they provide security at hospitals, et cetera. And so I think that one of the elements that's the most exciting about Regulation A, the new version, or A plus, if you will, is that we're bringing the cost of capital down to a place where companies that are never going to be Apple or Google have an opportunity to bring in outside funding. And so we all like to talk about these 100x big wins that the venture capital or the angels are going after. But 90% of the companies that make this country go, that deliver the products and services, that lay the carpet, that do the catering, are never going to be a 100x company. They're not going to hit the 50% IRRs that your venture and institutional investors like to think they're going to get. And so now we have a way for a very successful company that provides valuable products and services in your community to capitalize itself so that it's solid, it's stable, it's bankable, as Kim was talking about earlier, and it can grow to serve that community better. Additionally, all of your traditional infrastructure, your broker-dealers, your registered reps, your registered investment advisors, all of those guys are migrating to public securities. There's nothing that will get you an audit from FINRA and a lot of sit-down cuddle time with those guys like a Reg D offering. You do a Reg D private placement, they want to snuggle for a while, and they want to do it every year. And so the broker-dealers are moving to a public, even in the public non-traded REITs have been huge, but they're moving to public securities in order to avoid that and the risks that are inherent with that. And I think Regulation A Plus is going to be rapidly adopted, and you're going to see a lot of excitement in the broker-dealers once they get over their fear. Once some people start to do this, I think you're going to see a sort of a rush to this security.
Can I say something? Yeah, this is a global point, but so the question is, all of us who are evangelical about crowdfunding, and most of us in this room are, there are dangers. There are real dangers to the market. And one is that, for example, Regulation A, or Regulation A Plus, becomes like privately traded REITs, right? Privately traded REITs are horrible. The saying is they're not bought, they're sold. They are a financial product that are pushed at very high loads by broker-dealers, huge costs involved, low liquidity, just a really bad financial product that the government regulators hate. FINRA hates privately traded REITs. So when you're thinking about who's going to buy Reg A securities and how's that market going to work, if Regulation A and all of crowdfunding, for that matter, becomes like that, like the privately traded REIT market, that's not going to be I wouldn't count that as a success at all. On the flip side, the real danger in crowdfunding is that it becomes institutionalized. So Patch of Land, for example, and every portal out there sells more and more of their product to institutions, not individual investors. Lending Club and Prosper being the two biggest example. I mean, they started out as, we call them peer-to-peer lending sites. They're not peer-to-peer lending sites anymore. They originate loans to individuals, and then Wall Street buys them. I mean, that's an oversimplification, but it's not too much of an oversimplification. And so what happens is all the folks out there, including those in this room, who want to be entrepreneurial, crowdfunding, build the investment bank of the future, build the brand, you become merely originators for Wall Street institutional dollars. That's the real danger to this market. So on one side, having too much institutional money come into Reg A, and secondly, having the Reg A market be illiquid, high load deals, those are both real dangers, and I think we're going to have to really thread the needle to avoid both of those pitfalls in this market.
Let me just
Do you agree with that? Because if you disagree, don't talk.
No, I agree. That's 100% correct with respect to debt marketplace lending. I mean, that is what the market has become.
I just want to correct something very quickly.
Yeah.
Okay.
So today, Patch of Land is 100% retail investor crowdfunding.
Yeah. So
You don't have any institutional investors at your site?
yeah.
Buying product?
As of
Yep.
today, we have not had an institutional investor. We haven't like wholesaled or
Yeah, you're not going to see real estate platforms. Yeah, you're not
Okay.
going to see real estate platforms turning down equity. That's definitely the case with Lending Club and Prosper and P2P. But on the equity side, you should be so lucky, and the Reg A Plus market should be so lucky to have an institutional investor. It's going to be a retail market. I mean, at least for the foreseeable future.
And I guess my comment to that is it's not necessarily such a bad thing, because what institutional investors do is create liquidity in the market.
They do.
And it does allow for retail investors to gain the benefit of that, of course, with some downsides. But
Yeah, and-
very good.
and-
We got
yeah.
some more.
So the institutional investors are driving distribution and allowing the platforms to scale. So what's the distribution model that you're envisioning that would be better?
Well, the idea, and yes, there's a mix. It's great if you have institutions, they're increasing deal flow, they're legitimizing the investment. You're seeing that to some extent, like in the Title II space, with more and more people moving to the syndicate model almost. It's the same thing. Institutions legitimize investments, and you can do a lot more deals, so you can create efficiencies. What I don't want to see happen is for the retail investors to once again get frozen out of the market. And that's easy to happen, because if you're a portal and you're struggling to find investors, and an institution comes to you and says, I'll tell you what, we'll invest $100 million in your deals, but you have to show them to us first. You know, we're going to pick our deals, and then you can list them to the retail investor. That's hard to say no when you're a portal. It's hard to say no to that. And once that happens, then I think you're in a downward slide, because you're getting adverse selection to the retail market.
If I have a client that wants to do an equity deal and they have strong institutional interest, they're going to do a major offering and they're going straight to an exchange. Period. End of story. I mean, you're just never going to see any other instance. This is not going to be a market. Leaving the debt market aside, that's a totally different market. But on the equity side, that'll be a good day when you see institutional interest for these securities. I don't see that. I really don't see that.
Brian?
Yeah, thank you. This has been great. I just wanted to throw in a Canadian perspective. We wanted to thank the SEC for actually including Canadian companies in this, excluding
Every other
around.
only
I was-
country that we said is close enough to us. So yeah.
Thank you. Very happy. Two, all Reg A deals are going on the U.S. Come on up north, okay? Because for Canadian, this is vetted by a regulator. That's a big deal. Instead of having U.S. deals coming up north, you're kind of looking at them saying, why are you here? Why can't you raise money in the world's largest capital markets? It's going to have a different perspective. And the beauty of a Reg A Plus deal in Canada is we can work it with what's called an offering memorandum exemption, and it becomes like a wrapper, and you can sell it to the public with no limits. So you figure out a U.S. broker-dealer working with an exempt market dealer on a Reg A Plus deal, everyone's excited. I know the regulators are looking at some of the issues, such as you have to sell it under private placement exemption, they're not free trading. And there's one issue in terms of OTC issuers, that if you sell to Canadians, because of pump and dumps and otherwise, they can force you to become a public company, which is bad. Ontario has not subscribed to that. But we're pretty excited that from an investor perspective, and actually northbound deals, even the exchanges are looking at doing northbound deals, Reg A Plus, and maybe IPOs, and also southbound deals where, you know, mid-size or other Canadian issuers can access the Canadian market. So I just thought I'd throw that Canadian twist in the paragraph.
Okay, Brian, don't take this personally, but I'm going to throw in a dig on the Canadian side. You're right. The SEC,
always does
the
that.
SEC included U.S. and Canadian. However, and this is not your part of Canada, they excluded certain types of companies from using this, which
Oil
you're
and
familiar.
gas.
The folks that trade over in Vancouver, which I know is you can disclaim that, which is oil and gas and minerals. I mean the things that you know, the bright shiny objects that people throw money at that you know maybe isn't very real. So
It's a good point.
so I just I'm sorry, I couldn't resist.
No, it's okay, but
Yeah.
I want to turn that right around and just say I had to spend like 24 cents for every American dollar I got out of my Canadian dollar. So if you look at a Canadian perspective, yield, real estate, etc. Pretty exciting.
Well, is there demand in the Canadian investor market for U.S. deals per se? Are you saying that all of us who have clients who are trying to raise capital should raise it in Canada because you guys love U.S. companies the way you love baseball and basketball?
Missed hockey, but I think the answer is everyone loves a good deal, and if you look at the play on the U.S. dollar otherwise, and it hasn't been available, if you look at this as opening up the U.S. mid-market or mid-sized companies, that's exciting. A lot of dealers, they're learning about this and trying to figure it out. But I just wanted to make it known that there's a lot of love up north. If you can work with certain dealers or law firms to develop that, there is interest, just as there's interest down here.
Sam raised a point, though, about Vancouver. I mean, do Canadians feel about Vancouver the way Americans feel about California?
No, they feel that way.
I'm not going to answer this because I'm in Washington.
They feel about Vancouver the way Americans feel about Vancouver. I'm sure, right? About that, because he's talking about the market out there, the public stock market. Do Canadians have the same sense about that market that we do?
Well, I mean, there was the Vancouver Stock Exchange that doesn't exist anymore. There's just the TSX and the TSX Venture Exchange and the Canadian Stock Exchange. But my point is that there is a lot of opportunities and interest to work with other dealers up north on cross-border deals.
Okay.
Because I believe there's going to be a lot of really awesome deals in the U.S. that Canadian investors want to invest in.
Yeah, there will be cross-border activity, and that's a good thing, and it's going to go both ways. I mean, I've already heard from Canadian companies that are trading up there that want to come down here to use Reg A+. So it will go both ways, certainly because of folks like you and Alex McCormick and lots of U.S. attorneys that see that market opportunity. It'll, of course, happen. So.
I'll go first on predictions because I enjoy the fact that we all get them wrong all the time. That it's just fun since we're taping it. So my prediction is that you're going to see a lot of issuers who are using Reg A+ as a way to control market pricing on their process to becoming exchange traded. I think that you'll see that significantly in both real estate and also in areas like biotech. There'll be significant institutional participation, but they'll have an expectation that the company is going to be fully reporting an exchange trade within a relatively short amount of time. There's a lot of discomfort, obviously, with kind of opening up your company to public pricing by instantly being on an exchange, so I think that will happen. I also think that on, not necessarily the main cases, but beginning slowly and more surely, you will see companies that are consumer-based that will be utilizing this as an opportunity to integrate with their marketing efforts, an effort to have their customers kind of get a chance to become owners. And you'll also see larger brands affiliating and associating with companies that are raising money this way, because nothing says like we love a restaurant group more than Coca-Cola's logo or PepsiCo's logo. And I think that while that will be on the edges in kind of terms of Richard Schwartz analysis, I think from a media narrative, I think that that's going to be a big change in the next year to year and a half. That's my prediction. Sam?
I hope you're right about institutional interest. There certainly will be, I think, smaller funds that are going to see the opportunities to invest in quality companies that will ultimately uplist to a national exchange. I think that's a great risk-reward play for the right money. So certainly there, once a company has come out of a Reg A+ offering, I think that'll be the case. So I think that's right. Consumer goods, absolutely. I mean, VCs are not generally fond of consumer companies, so I think that's true. And affinity groups, one in particular, just some feedback I got from a fellow securities attorney who attended the April 20th 4-day marijuana conference in Denver, Colorado. There is a lot of interest there. I think actually it's a good fit for some of these marijuana-related companies. There are a lot of, not my term, his term, stoners, unaccredited investors who will throw money at these companies, and companies that are happy to be trading on OTCQB. So you're going to see all shapes and sizes out there.
And on a side note, this is like a major geographical divide thing. For us out in the West, we see enormous amounts of money going through these marijuana-related businesses. We see a lot of companies that are doing reverse mergers that are marijuana-related businesses. No deal is too big. I just completed a $110 million private placement in the marijuana-related businesses. It's a huge, huge business, which if you're from the east side, you think that this is like a stoner, like a very kind of insulated thing. It isn't. It's giant. Mark, on predictions.
I mean, I think the Bulls will beat the Cavaliers in this round of the playoffs.
There's just no way after last night.
I mean, I personally don't, I don't try to make predictions because we all are wrong, and it all depends on, I just got early in my career, I used to follow proposed legislation and the bills that were introduced and so forth, and I just got, that is, I always found it to be, not intellectual masturbation, sort of. It's just, you just can never tell what's going to happen. I think Regulation A is going to be small in the beginning because I just don't know how much demand there is for the securities from retail investors. I think it's going to be real big in the future, but over the next year, I would predict a very small, a very limited market. I think affinity groups, whether it's consumer goods or the Cystic Fibrosis Foundation, if you're a biotech company and you have a new therapy and you go to the Cystic Fibrosis Foundation and you can contact all their members, and that could be a good thing. But we tend to focus on the supply part of the equation. All of us here represent suppliers, meaning issuers, or we are issuers. The demand side of the equation is the big question. Sydney is holding up a blank piece of paper to me, so I'm not sure what that means. I guess it means stop talking. So I don't have any huge equations. I think the market's going to be small and hopefully profitable and clean and vibrant.
My predictions are that Reg A will largely replace Reg D for a lot of offerings. I predict that Allegiance's offering that probably hit the market sometime in September will be oversubscribed. And I predict further, and these are the ones that are going to come true. The lawyers are going to earn large fees, and they're going to get paid. The accountants will earn large fees, and they're going to get paid. And the broker-dealers and the registered investment advisors are going to earn commissions, and they're all going to get paid.
And the issuers will get most of the money.
We usually leave most of it. Final comments?
I would echo Steve's comments there that I think that this is going to bite into Reg D a lot, and I think the key to that is the ongoing reporting requirements, like came up over and over again. Is information is very valuable to investors, and this is the first thing aside from publicly traded companies where that's mandated and going to be out there, and you have the audit requirement to legitimize the numbers and all the current reporting requirements and all that stuff is just something that the private markets have never seen anything close to that before. And I think as people become aware of this, it's going to be very valuable. And
I will tell you, I absolutely disagree. I do not think Reg A is displacing Reg D in any significant way, in any kind of near-term way, because Reg D is so fast, it's cheap, and the accredited investors have the money. I mean, most deals are, trillions of dollars of deals are done in private networks. They're not going to say, let's file Reg A instead.
You're assuming, though, that the Reg D investor is a different investor than the Reg A investor. And I would tell you that what you're going to see is a ton of accredited people are going to be doing Reg A deals because Reg A deals are going to replace Reg D in terms of offerings, right? So,
if I'm an issuer who knows he can raise all the money he needs from accredited investors, why am I going to use Reg A?
Because your broker dealers won't sell your Reg Ds anymore.
So we do need to wrap up, but with all that being said, that's why I do predictions at the end. The fight outdoors will begin shortly. I want to thank the panel, and we're going to roll right into the next panel, Sid. We're going to roll right into the next panel. Thank you, guys.